Hi, this is Lex, and welcome to the FinTech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everyone, and welcome to today's conversation. We are very fortunate to have with us today Michael Egorov, who is the founder of Curve Finance, as well as founder of YieldBasis. He is one of the original entrepreneurs in decentralized finance, is extremely technical, and has a wealth of knowledge in the space. I'm super excited to have him with us today. Michael, welcome to the conversation.
Thank you.
I want to zoom out to your background and how you got into financial markets in the first place. You started out as a physicist, right?
Yes, that's right.
What did you study and what was your area of interest?
Of course, first, when you study physics, you study it kind of generally, and then it was going a little bit into optics and stuff like that. And this optics brought me to apparently laser cooling, like making atoms very, very cool using lasers to such a degree that they stop being just particles and merge into one giant matter wave called Bose-Einstein condensate. And that I actually was doing experimentally, so not in theory, but like in real experimental setup, which is, made of vacuum, lasers, magnetic coils, stuff like that. So it was a great experience, I must say. After doing PhD there, I was doing postdoc in the similar area, but at about that time, when was that? 2013, I think, I started thinking of both doing some company for that I was planning to go to the United States at that time, and actually I did. And I discovered Bitcoin. Well, anyway, when I first went to the United States, to just get started somewhere, I went to work in LinkedIn. After that, founded a company called NuCypher, which is now known as one of the main contributors to Threshold Network. So they merged with Keep to essentially build Threshold Network later on. But anyway, so I worked on that one from 2016 till founded Curve till 2020, essentially. With Curve, it was actually, I would say, driven by a few things. One was I looked at how staking works how NuCypher worked at the time. It did use staking, and I thought about liquid staking. And that brought me to the necessity to make some AMM for liquid staking, right? So, but we know now that Curve is used as AMM for liquid staking. So that was one of the original ideas. But also, I was a user of MakerDAO since end of 2018. And I was essentially borrowing DAI against ETH because I didn't really want to sell ETH. And but I did notice that markets for DAI were not very efficient at all, even if you go to centralized exchanges where it was listed. So I thought that something needs to be done. And this all led me to making Curve, which started as an exchange to swap between the stablecoins, essentially. And that's probably the major use case for Curve today still.
I'm very interested in going deeper on DeFi, of course, but I want to just spend some time on maybe like the philosophical question up front, which is there are many physicists and, of course, more generally, quantitative people that are extremely successful in finance. And I always wonder about kind of this transition between physics, which is at least generally speaking like observable and a hard science, and financial markets, which are quantitative but are so squishy and human. What do you think about the transition from physics to economics or to finance? And then do you think about the sort of like it's in the nature of the markets versus, the hardness of physics?
I think the biggest attractive part in financial markets is that economists, they generally have no clue. And it's a lot of things are not invented in economics. And usually physicists are able to bring a lot of insight into that area. So, like, you have this way of thinking, which you have in theoretical mechanics and maybe quantum mechanics, which you can bring to, I don't know, to building automatic market makers. And that appears pretty good.
What is that way of thinking?
In theoretical mechanics, you work out from invariance. You don't really think from, I don't know, from velocity and momentum perspective. You more think from like things like action and stuff like that. So like in invariance, and you derive everything from there, and you can apply similar way of thinking to automatic market making. You make some invariants, but it's not like you discover some laws, you write laws. So in physics, you discover existing laws of physics and make some mathematical description for those. Here in finance, you write your own laws for money, and basically money within your little universe, within your AMM, follow these laws. You just define these laws in such a way that your AMM is profitable, right? So that's kind of interesting perspective. So you write your own laws of physics, but for money. So money follow new laws of physics. That's kind of exciting, isn't it? I don't think economists generally do that. Right. But anyway, I think I would need to describe some of my findings in some coherent way because I didn't really explain many of them publicly. I don't know. It's like research which hasn't been done in finance, whether decentralized or not. And that does correspond to what I've seen in the past. I've seen people who, like, for example, I know one person who had 2 gold medals on International Physics Olympiads, and yet he, after doing some PhDs and whatever, he went to work for a trading company. Or another person who studied with me got very good physics education, and she became a professor in economics. So it's very common. Or I've been on some physics conference back in the days, and I've seen some physicists who turned into economics explaining how he applied theory, which is like essentially for black holes, to economics. Right. So it's just a lot of similarities sometimes. Maybe it's not that it's similar. Well, in DeFi, you can also like define your own laws essentially and make everything follows these laws very strictly inside the AMM, and then you have some hard ground to stand on. Yeah, so it's not really all squishy as you might think.
Crypto's a bit of a black hole then, isn't it, for money? What resonates is this idea that economists kind of describe what's happened post hoc. And unless you're running the Federal Reserve, historically, you didn't have the opportunity to design economies. And what crypto's unlocked at scale is, there's still only a select group of people who are able to do this well. But for some group of people, you can design your own economy. And that's pretty amazing.
What crypto systems are, they are macroeconomics, essentially. So, and you can design different macroeconomic systems and do macroeconomic experiments, but they don't have to last tens or hundreds of years. They happen very, very quickly on chain, and you see the results immediately. And I mean, you hope that your theory is right and that the experiment will be successful, or maybe you see that something could have been done better, and you can iterate on a much faster than if you had to design economies for new countries, and then the whole country is participating in the experiment. That doesn't really happen in the reality, because it's one probably shouldn't do that. But in crypto, that happens all the time.
If I go to the next thought, which is around Curve itself, we talked about how you're able to engineer these laws or these incentives and kind of applied microeconomics. Curve was one of the original DeFi projects as a stablecoin AMM, having, avoiding the slippage that Uniswap did for being a general AMM. Can you talk about the innovations that Curve brought to market, in particular, maybe this idea around stablecoin to stablecoin, the idea around VE locked model and the bribing wars? Like, what are those mechanics?
The stablecoin to stablecoin AMM was essentially the first concentrated liquidity on the market, I think. So at the time, I did realize the way which resulted in, which led to creation of Uniswap 3, but I thought that maybe it's better if liquidity doesn't get crafted manually, but it's like fully automated. And I think Curve is still into fully automated liquidity provision, not in like manually crafted liquidity. But anyway, Curve was the first concentrated liquidity, I would say. Later, when I felt the urge to fully decentralize the all the Curve, right? I thought that one token, one vote is kind of a silly system. So I thought that maybe we can do better. So I figured out this veTokenomics. And the main idea is that if you get governance rights in the protocol, you probably shouldn't be able to leave this position too quickly, so you should be invested in your decision, right? So and for that you lock your CRV tokens, you get VE-CRV voting power, and this power decays towards the unlock. So your voting power is essentially the product of your tokens and the time left before you can unlock and move the tokens around. So if you can move the tokens around like a second later, then maybe your voting power should be near zero. And if you are invested in the protocol, then yes, then your voting power is big. So that was the idea, and I did it for Curve with veTokenomics, and that proved to be fairly good. Well, if governance was the only function of the token, that wouldn't be very good for users. So we thought that maybe we need to do fee distribution to those who VE locked tokens. So if you are invested in the future of the protocol, maybe you should get something from it, which is fees from the protocol. And that appeared to be also very good. But I think you also mentioned buying the votes, or how people call it, bribes.
Maybe we'll pause here for a second. The way I interpret it, right? Like, there's a big problem with market structure, and I want to talk about that later, but there's a supply and demand of a token. Lots of people are very short-term oriented. So if they get a token as an airdrop or from some sort of activity, they want to convert it into, let's just say, a more fungible currency. And so unless they get paid for not converting out of it, and they can do that in what you described by trading duration or trading illiquidity for the power to control markets in Curve. And that means sending rewards to different pools and kind of changing returns in different pools, or by getting some sort of yield and return. But end of the day, you're still left with two problems. Number one is, yes, there's some portion of the token that's going to get locked up, but you're kind of introducing sort of like a random walk of unlocks into your token price, which means that like there's going to be big chunks of selling or unlocking and selling like at random times, depending on people's desire to govern or not, and these incentives. And then number two is the derivatives issue, right? Like, because you're telling people to put stuff in a box, and then you're saying the box isn't going to get opened for this much time. And then, as we've seen with liquid staking, what happens is that somebody just takes your box and puts it into a different box and then treats the other box.
Yeah, that makes sense.
How do you think about that? How do you deal with it? Is there a way around it, or does it just not matter?
Unlocks, I didn't see that being a big problem because the average lock time for CRV tokens in the eCRV is larger than 3 years anyway, right? So there are not too many unlocks actually, because like people, if they have lock ending at some point, if they don't extend their lock, then their returns and voting power gets diminished towards the unlock. So they extend the lock, and most of the people prefer lock tokens to stay locked. So they are, I don't know, they are practically locked forever in most cases. I mean, of course, they can stop extending the locks and wait for like 4 years or whatever and get the tokens unlocked. But in reality, not too many people do it. So this doesn't appear to be a problem for the market. I mean, much less of a problem than, I don't know, than cliffs, for example. But with the liquid VECRV derivatives, that's a problem more interesting question. Because if you imagine a liquid derivative, then you either give your voting power to someone else, like in convex case, or in stake DAO, you still have some voting power with your derivative. And then the question is, doesn't it circumvent the original purpose of locking? Like in principle, you don't have to be that much invested in the protocol. And that was my original thinking, but it appeared to be that it's not that simple. If you have a wrapper, then liquidity of this wrapper isn't necessarily very huge. So you cannot expect the VECRV wrapper to be on peg forever, or to be able to absorb like a big selling power if you are a whale who wants to exit. And you still trade for illiquidity essentially, right? So you get like revenues, you probably get some voting power, but in exchange you still get illiquidity. It's just different illiquidity. Instead of just a straight lock, you may get market-based illiquidity with wrappers.
Shallow markets, right?
Yes, and that appears to be acceptable. That appears to still be, I would say, keeping people somewhat invested in their decisions when they vote.
In the old world of finance, it reminds me of who votes equity decisions for large companies, right? Like in, let's say, Apple or Microsoft or Oracle, like who's actually going out and voting. And so much of the ownership of these companies is in a huge BlackRock index fund. And the BlackRock, index fund managers don't care to vote board issues because they are conflicted. They own Microsoft and IBM and Oracle. And so what they do is they hire a tiny company, I think like a 500 million market cap company that's been sold and bought by every exchange group around. I think it now sits with Deutsche Börse, and it's called the Institutional Share Group, I believe, or something like that. And it's just, one shop that goes out and votes on all of the board issues, all of the shareholder issues. And they have policies, and they do it on behalf of large holders of financial instruments. And, way, you mentioned stake DAO and so on. The pattern is really similar. It resembles that.
Not quite, because on stake DAO and on convex, maybe YEarn is exception for now, but you have voters inside the protocol whose votes are split into curve votes. So in convex, you need the LCVX holders to vote, and then their votes are casted to curve. In stake DAO, it's a little bit trickier. You have to have SDCRV, but you can have votes amplified by VESDT, right? So if you are invested in both stake DAO and the wrapper, then you have voting power somehow bigger. But anyway, you still have votes of participants split into curve votes. So you don't actually have one large body voting. You have votes of participants of those ecosystems voting. So you still have some sort of, you still have decentralization. It's just, how to say, maybe a little bit similar to like representatives of different regions, but maybe not exactly. But anyway, you still have decentralization. You still have democracy. It's not like everyone delegates to one entity and doesn't care. It's quite opposite. And I would say, if you want to get DAO to vote on your proposal, you need to campaign around it. It's not easy. It's not an easy thing. Pretty stressful, I would say. But if it reminds something, it probably does remind elections.
Who are the market participants that routinely drive for voting? What's the shape of the entities that care about this?
Well, I mean, you have big projects. Well, you have individual voters, of course, a little bit. You have large projects like Convex, StakeDAO, and Yearn. Some voting power in StakeDAO, and also some voting power in Convex is going from projects from Aladdin DAO, and I think there are a few others. And really, I mean, it's an interesting landscape. It's like not even easy for me to grasp, but it's not artificially made. It just naturally appeared, and I'm just trying to learn it. But you just define the rules, and then something grows on top of these rules, and you are wondering, oh, what is this? And trying to work with that. But rules are the rules. So it's just fascinating how establishing some rules leads to growing of something which you couldn't even imagine.
Wolfram's sort of game of life.
It's this landscape of voters is changing all the time, actually, right? So, I mean, voters in Convex or in StakeDAO can really change over time, and what you knew about voters maybe a year ago, 2 years ago, might be not the case today. But it's still very interesting. But again, it reminds me countries and elections, not really companies. And what fascinates me is when you introduce veTokenomics rather than one token, one vote, like voting shares in companies, your quorums in DAO are much larger somehow. So, for example, the vote to essentially make a credit line of Curve USD for YieldBasis system, like the recent vote, got 93% quorum, which is insane, I think. And in systems where you have one token, one vote, you often see 5% quorums, and it's a huge difference.
Let's open up just some of the business terms around it before going into market structure. Can you talk about the size that the Curve AMM got to and the size that the Curve token got to, and then maybe use that as a transition to YieldBasis and how that project came around?
Right. Well, if you judge by TVL, Curve TVL, actually, it was very huge in around the end of 2021. It was 25 billions, which was the biggest DeFi project at the time. Right now, I think it sits just above 2 billions for some time. And I think the reason was that market probably realized that stablecoin AMMs are efficient, and you don't necessarily need a whole lot of liquidity to support the market. And of course, you have many stablecoins, but not overly too many. And well, it appears that probably this TVL is enough to hold stablecoin market and well, maybe market of staked ethers and so on. But I think with YieldBasis, I started pushing into volatile swaps territory, and we will see where we will end up.
Yeah, so tell us more about YieldBasis. And I guess kind of to unpack your point, the 2 billion in TVL is effectively the liquidity pool that's sufficient to get all that transaction volume through for stablecoin conversions and for ETH and staked ETH conversions. If you have 10x the volume, then you might have 10x the TVL, but the factory is efficient. Now comes Bitcoin, right? Like over the last 2 years, Bitcoin has been the big success story in terms of capital appreciation, not so much in terms of for smaller tokens. So what does YieldBasis do and how do you think about it?
In 2021, I introduced CryptoSwap AMM. And what it actually is, it's like AMM with automatically managed concentrated liquidity. The main idea was that you have some background liquidity, which is a little bit like Uniswap 2, and you have some part which is concentrated and automatically managed. I worked out through these invariants and all the cool stuff which reminds theoretical mechanics to how to manage concentrated liquidity to cause no losses. Right? Well, no losses compared to what? Compared to Uniswap 2, actually. But anyway. And of course, the idea was that concentrated liquidity probably should make AMM performing a little bit better than not concentrated. And it was, well, it is true to some degree, right? So you can get APR maybe twice as big as Uniswap 2, but you still have impermanent loss, and it is still the same. I mean, in Uniswap 3, by the way, impermanent loss is typically larger because you manually manage your concentrated liquidity, and if you leave it at the same place, you actually have your impermanent loss higher than in Uniswap 2. But if you have your concentrated liquidity automatically managed, then you can have impermanent loss, essentially exactly like in Uniswap 2, while having concentrated liquidity. But it appears to be not good enough because, let's take Bitcoin, right? Bitcoin price appreciated like 4 times, right? So like from 20K to 80K, essentially, right? And when it appreciates 4 times, then if you put it in AMM, whether it's Curve CryptoSwap AMM or Uniswap 2 or whatever versus USD, then your liquidity appreciates only by a factor of 2, right? And you think, okay, well, maybe it's not too bad. But if you think about it, if you take this same Bitcoin and, I don't know, sell half of it for USD, and then they do nothing, and Bitcoin appreciates 4 times, then your liquidity which is not working as liquidity, would appreciate 2.5x compared to 2x, which you have in Uniswap 2 AMM or in Curve AMM. And of course, on top of that, you earn fees, but will these fees be larger than the 0.5 difference between them? And it appears that no, it's actually these fees, they will not necessarily be larger, and many people think it's a loss, but actually it's not a loss. It's just, just what the property of the bonding curve. But you can change the shape of the bonding curve back to a straight line, and you actually can get rid of it. Although it's not free, but nevertheless, it appears that you can go back to, pricing like Bitcoin and have some profit on top earned in AMM, even after you paid all these expenses of transforming the bonding curve back to the straight line. And that's what YieldBasis is doing. It's basically having AMM, which has impermanent loss, right? It's putting that AMM inside another AMM, which has what I would call impermanent gain. And impermanent loss and impermanent gain together cancel out, and you have just Bitcoin price plus some fees if you earned them. But, well, problem is that you have expenses on doing this impermanent gain thing, essentially. And you're not guaranteed to have net profit after that. But it appears statistically that you do have net profit if volatility of the asset is high enough and good enough, right? And Bitcoin still has this volatility, which is good enough to earn something. And I think for Ethereum, it's also true. But you need volatility profile of the asset to be, I would say, good volatility, right? So you want asset price to be sort of returning to some trend line, more or less. You probably saw like Bitcoin in the recent few weeks, jumping up and jumping down and jumping up and then again jumping down. So that's essentially what you want, right? You know, its price can drift over time, but these up and down movements, they should make some profit, and they do. It's just you just need to manage liquidity so that this overall price movement doesn't screw them up, and that's what essentially YieldBasis does.
Who is the customer for YieldBasis, and what are the markets in which kind of this volatility is realized? In simple terms, like, is it YieldBasis is going out and participating in markets, or is it the venue itself? And then who is the ideal customer or user?
Well, YieldBasis creates liquidity, I would say this, right? So if there are traders who exchange in that AMM, but YieldBasis creates liquidity by a combination of curve pools and YieldBasis AMM. So that's, in a sense, YieldBasis takes a market maker role. But people who deposit funds in YieldBasis, they, I think, want to earn some yield on their Bitcoin, essentially, right? Or, I mean, Ether when Ethereum will be added and so on.
Are there any technical challenges in terms of going cross-chain?
I mean, you don't really have to introduce cross-chain as inside the protocol itself. I mean, it can be deployed on other chains for sure, right? But you don't really need to introduce hopping between chains inside the protocol itself, because like it's unnecessary complication, I think.
From a user perspective, what's the flow? Do I show up with Bitcoin, or do I show up with wrapped Bitcoin, or like
Bitcoin, wrapped Bitcoin? Yeah, you go with wrapped Bitcoin and deposit, and that's it.
And so I think today it's sitting at a couple of 100 million of TVL. What do you think is the market size that's likely for the protocol?
Yeah, that's a good question. It's like how is it best to grow it? But from the perspective of, like, from Bitcoin volatility perspective, like we're earning money from volatility essentially, right? And question is when that would saturate. When will the yields saturate? And I think I tried to estimate, I think it's maybe somewhere around 50 billions or something. I think that's where we will start seeing saturation. We're a little bit far from that, though.
Yeah, I think that's like 10x the size of the wrapped Bitcoin market, right?
Yeah. So it's still kind of a long way, and it's still in its baby mode, I would say. But YieldBasis already created biggest wrapped Bitcoin pools on chain. That's kind of insane, actually. But yeah, but the size can be 100 times bigger eventually.
Yeah, I mean, I remember talking to the Athena team very early on in their journey and asking, like, what do you think is the maximum size of that strategy? And they said around 6 billion, everything starts to break, and then in 2 years, I think they're...
I think they are still correct in terms of order of magnitude, right? So, like, their size is limited to the market you can get in, like, farming shorts, essentially, right? So you are limited by amount of loans on the market, right? And I think they estimated from that at the time, maybe it was 6 billions, but, it doesn't stay constant. It can totally grow by factor of, 2, 3, 5, but it can squeeze by the same factor. That's totally expected. So they haven't been wrong. And here, like plus minus half an order of magnitude is definitely can happen. It's not something unexpected at all, right? So I think that's kind of the case here. Well, of course, the size of this market can grow with the asset appreciating in price, so becoming bigger. That's possible. It can grow by introducing more assets, so it's that's also possible. But I think you get the idea. That 50 billion size I thought of was pretty much for Bitcoin. But of course, we all know that Bitcoin will become the world's reserve currency, and hyper Bitcoinization will happen, and so on. So we all believe that.
We're all driving on the road, and hopefully there's not a wall in front of us.
Right. And we all believe into the future introduced by Satoshi.
I want to land us in a somewhat complicated topic. You have a lot of hands-on market experience in DeFi. And the question is going to be around tokens in general. Maybe I'll call them equity tokens, in the sense that tokens that function like shareholder rights or economic rights over a protocol. And I think, especially over the last 2-3 years, there's been sort of disappointment for crypto investors, myself included, in that while we've had very strong interest in markets in Bitcoin, there's been a bunch of market structure issues around altcoins or project tokens or, longer tail assets more broadly, whether it's, Curve or Athena or other assets. They are not priced in a predictable way like equities. Some of the sort of like revenue to market cap valuations are pretty dire. And at the same time, there's sort of these unlocking or vesting schedules in a lot of tokens, which create selling pressure even when the projects are strong. You've been public around having your personal balance sheet of Curve locked into different borrowing protocols, and then using that capital on supporting the price and things like that.
Yeah, well, actually, I didn't do anything special for affecting the price. It's actually, for me, it's a little bit of an unknown thing how protocol builders can directly affect the price. That's something I've never done.
Absolutely fair. Maybe I'll point then to Hyperliquid, right? And the use of protocol revenues to buy back the token with the story as if that affects the price.
Yes, but the direct buybacks, they create very, very small buy pressure, really.
Yeah, I mean, if you look at the numbers, it just, throwing 40 million per year into a...
Yeah, it's absolutely nothing. And I think it's more of a combination of people believing that buybacks is something affecting the price and price manipulation. But if one just does buybacks, it doesn't do anything. I think it's all price manipulation, really.
And this is like small floats of tokens, and then...
Yeah, I don't know how it's done, though, so I'm not...
Yeah, this isn't the direction I'm quite trying to go into.
What I'm trying to say is that, of course, buybacks do connect economic value of the system to the token value. If it's buybacks which go back into project's treasury, then there is a possibility that these tokens will be sold on the free market in the future. So that reduces token velocity, but that doesn't reduce the supply, and market reacts on that one way, right? It could be buyback and burn. When tokens are bought from free market, they disappear from circulation, and when they are burned, they disappear from circulation forever. Right, so that's a different story. And in principle, it should be more efficient. But I mean, at the moment of buying, it's the same buying, but psychologically people realize that these tokens will never come back to the market. And of course, there is veTokenomics, where tokens, well, people see the fees they can earn in the protocol, or like they can sell their votes or whatever. And for that purpose, they buy tokens and lock them in, like either directly or in wrapped VE tokens or whatever. And that removes those tokens from circulation. In principle, it doesn't have to be forever, but practically most of these locks, they do happen forever. And we've seen that at least in the first several years, VE locking of CRV tokens removed 3 times more tokens from circulation than buybacks would have done.
Yep, that makes sense. And I think in many ways, it's like we talked about microeconomics and managing an economy. In gaming, you would talk about, sinks for the virtual currency, and you're sort of, end of the day, it's supply and demand.
Right. But there is also an issue of human psychology, and, well, some people think it's very bullish when tokens burn, right? So buybacks and burn, they create very good sentiment, maybe. Or, well, maybe this sentiment is raised artificially, but here we are. People do believe that burning is something very bullish. Also, I think that free markets are very irrational. They can misprice tokens easily by factor of 10, either way, or by factor of infinity. If you think about meme coins, their fair price is 0, and yet they are traded above 0, right? So they are infinitely mispriced.
Yep. But I think you kind of add up all these different sinks where you've got, for a while, I remember there were many chains where just staking the thing led to 80% of the coins being staked. ETH, I think, is only 25 to 35% staked. And then you have the sort of like governance and fee-driven staking with the VE mechanics, and that can add a bit more. And then you might have some sort of alchemy around buyback and burn from the protocol revenues, although nobody's making really enough money to deal with sufficient volume. And so we've tried all of these different incentives, and it still feels like a whole bunch of the market structure is just broken. Like, it feels very fragile, like token valuations. Do you have any thoughts around this question of between the large centralized exchanges and the decentralized exchanges, and sort of like all these experiments of incentivizing people to hold, and these like selling overhangs of investor tokens and team tokens and so on? Like, it doesn't seem to be enough. Like, what is it as an industry that we can do to try to address the market structure question such that, regular people who are buying the tokens of projects they like have a better investment experience?
It's anyway going to be in such a way that only long-term, like very long-term participants will like truly realize the value of the token. But here we have a problem. Like in Curve, we do have all the economics connected together. And of course, there are risks. Like, will Curve have its place in the future? Will it be bigger? Will it be smaller? What will happen in the future with the project itself? That is, of course, some sort of uncertainty which can be interpreted either way for the token, like either up or down. But at least economic value is connected. So you have fees going to VE CRV token lockers. And with projects like Uniswap, you have another uncertainty. You have fees, but like you don't have admin fee switch on, and then there is an uncertainty whether Uniswap will at all turn the fee switch on. And another uncertainty, wouldn't it, like, what is the profit and loss margins people are operating at when they're LPing on Uniswap, and wouldn't admin fee kill all the incentives to provide liquidity on Uniswap? And that's another uncertainty. It hasn't been done, so it's an uncertainty. And most projects didn't truly turn the fee switch on. And by turning fee switch on, I mean that value goes back to token holders or token lockers or whatever, not getting collected somewhere, but actually goes back to the people. That is not happening in these projects. And like, if you don't even talk about general public, if you talk about someone who analyzes deeply these projects, they just cannot analyze, they cannot predict like whether these projects will do it and how turning fee switch would affect the performance of the projects themselves. And in traditional finance, I think everything started with dividends, right? And then, of course, there are companies who don't yet distribute dividends. They invest back in growth. They introduce a little bit more of uncertainty. But I think it's still less uncertainty than in decentralized projects, especially when a project makes a token and didn't quite figure how they make money for those who have the token. And then if they have some earnings, they use it just to build the project, and then they sell out the company and the token is thrown away out of the window, right? So, and that is probably the worst scenario, which is still successful for the team, but definitely not a good one for those who purchase the token. Yeah, so this is things like this, they introduce uncertainty. And I think another problem is that the general public, they don't really think so deeply. They don't really analyze that deeply. And they think, all the projects are the same. So if that project doesn't perform well, maybe the whole category doesn't have to perform well. And then then hype waves appear, like with meme coins. So people invest in meme coins because they grow and the whole category grows, and then it crashes and everyone is disappointed. But I think you need some good foundation which you can analyze. And I think you can have it with DeFi, but you do need economic systems to be fully connected.
Difficult question. I think the only thing we can do is just continue to work through it.
Yeah, we can build. Yeah, and I think we just need more projects to turn the fee switch on. And of course, it can be good, it can be bad, but we will remove the uncertainty.
Yeah, that's the experimental part of it. Michael, thank you so much for joining me today. If our listeners want to learn more about YieldBasis, you or Curve, where should they go?
If you want to learn about Curve, you go to curve.finance, and you have a bunch of links on the bottom of the swap page, essentially. So you can go through those. On YieldBasis, you can go to yieldbasis.com, and there are plenty of links, like documentation. You can go chat in community as well and ask questions. So yeah. And I think in both projects, most active discussions with community are happening on Telegram.
Fantastic. Thank you so much for joining me today.
Thank you. Very thoughtful discussion.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things FinTech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.